Hello and welcome to this episode of Mutual Fund Masters. Joining me today is Mr. DP Singh, who's the Executive Director and Chief Business Officer at SBI Mutual Fund, India's largest mutual fund. Thank you very much, Mr. Singh, in these difficult times to take time out to talk to our viewers. My first question to you is, how are investors really coping according to you? You're the largest mutual fund house. What's the trend you are seeing? It's obviously very difficult times that investors are going through. How are they coping?
Actually, the present time, the current, I'll say last 1 month has been very, very destructive. Things, actually, we all know that pandemic started last year, sometime in the month of February, we started getting affected. But after the initial period, there was a lot of, the market was going on very well. And there we saw a trend where people started putting money directly into equities. There was a lot of shift, a lot of new demat accounts were opened, and people were putting money there. Of late, I'll say in the month of February, March, we saw a little this, and our mutual funds were always negative during the last 1 year because they were outflows. But of late, in the month of March, we saw a little change in the trend, and people started. The mutual fund industry was again positive, and we saw that even the SIP numbers went up. But today, what I'm seeing is as far as the current 1 month is concerned, people are actually sitting where they are. We are seeing very, very less fresh flows, very fresh transactions. But at the same time, there's one more thing which we have noticed. There are not much of redemptions. People are not panicking. People are having confidence in the economy. Everybody is, if I want to change the narrative into a narrative on the way investors are behaving, then I will say that everybody has a confidence this is a temporary phenomenon and things will improve. Nobody is getting into a panic mode. They are not taking the money out and they are not getting into cash. That is something I think in such a scenario, the way the pandemic has gone all around in the country, even this scenario that people are not panicking and they are not taking the money out is a very, very healthy sign as far as investments are concerned. So that's the trend which we have noticed.
You've been a great believer of systematic withdrawal plan or SWP. You've talked about it a lot. Do you believe that this is the time when people are suddenly seeing perhaps a halt in income, heightened expenditure due to grappling with this sickness and this disease, that this is a good time perhaps to use this tool to draw down some money if you need it?
Yeah, definitely. Then we have seen that actually number of SWPs have gone up also in the recent past. In fact, SWP is no more something which people don't know. This is becoming as much popular as SIPs were. But it will take some time. But as you rightly said, in such a abnormal time when there are a lot of uncertainties, people can have a dip into their investments, and they can take now when the shops are closed, when the business ventures are closed. But more than anybody else, I think this is a learning for the people who have not been investing till now, that they need to have some investable investments from where they can take a dip at the time. Because what we have seen today, when all of us know the penetration of mutual funds is very, very low, even now. But during this period, when 2-3 big trends which we have seen, first is the millennials have started investing. I say even if they have started investing in direct equities, that's at least they are getting the taste of the investments, and eventually they will come through mutual fund routes. And second is the people who had been putting money, they are now withdrawing, and we, to the extent possible, we are trying to tell them that to take the dip in bits and pieces, take it in a systematic manner, so that your returns are very, very tax efficient as well. And I think this trend will catch up very, very strongly in coming 6 to 12 months. That is my firm belief.
Mr. Singh, while the focus is always on equity, would like to understand from you, how do you see debt returns playing out? It's a big part of the market, even for retail investors now, it's growing. How do you see debt fund returns playing out in the coming months?
See, what has happened in the case of debt funds, the people who put in money 2-3 years ago, they are sitting on a very, very good returns. because of the capital gain, because the interest rates kept on moving downwards and there were capital gains in the market, and they're saying that the NAV moved up at an annualized rate of anywhere between 10 to 12, 13, 14%. But today the scenario is such that because of the pandemic and because of all the economic disruptions which are happening, it's very difficult at this point of time, even for the regulators or even for the government, to keep the interest, bringing them down and down and down. The growth is an agenda which is there, and the inflation also they want to keep it within 4-5%. But fact of the matter is that inflation is likely to go up. The prices of all the commodities are going up. In such a scenario, we can't foresee that the interest rate will further come down in another 1 to 2 years. In such a scenario, only the funds where the YTMs can be locked, and the YTMs are better than the bank FDs. Even those are the funds which will be good as of now. For that matter, the fixed maturity plans, whatever will come, will be something which should be very good for the investors. So, but because otherwise all the debt funds are the YTM of the funds are ranging between somewhere between 4.5% to maximum 6 to 7%. 7% being the highest level in the credit risk kind of funds. So the credit risk in any case is not something which is getting a lot of money. So the only option for the investors as of now is to lock the money at the current YTMs in FMPs, which may give them around because the money can be locked in at a YTM of around 6%. Because 10-year GSEC is 6%, and if we go to the shorter term, so I think in the corporate papers and in other AAA rated papers also, the secured papers also, the yields could be somewhere hovering around 6%. That is in any case 50%, 40-50 basis points higher than the bank FD rate. And with the tax efficiencies built in the FMPs, I think this is the best time to park money, number one, in the your FMPs. Credit risk fund also, with the quality of credit now being very high in all the credit risk funds, that is another category where people can park money. But yes, starting point from liquid funds and this money market funds, those funds will definitely give better returns than your savings bank account. That is for sure.
You talked about credit risk funds, and we saw this big setback last year with Franklin Templeton, and in fact, you've been entrusted with the job of getting the money back, recovering it, and giving it back to investors. You've made some fairly good progress on that front. If you could tell us what is the current update?
Yeah, see, when the funds were closed for subscription on 26th March 2020, the total AUM size was around 26,000 crores. And by the time it came back to us, when we took the 26,000 crores, including some cash which was already there in the fund, we have already made 2 tranches of payment, and as per the numbers, the 56% of whatever was there on 26th March 2020 has already gone back to the investors. The last tranche we gave yesterday only, and we paid around 2,800 crores. And with our kind of breadth and with our kind of AUM which we are managing in our schemes, I am quite confident that we should be able to sell these securities at a very good price. And very happy to share with you that we have not sold even a single security at a loss. Each and every single security has been sold at a price which is higher than the valuation price which was already there in the NAV. So we are trying to make sure that investors, this could be Franklin Templeton, but investor is one category. We are committed to them that will optimize the returns also by selling them at a very fair and optimum price. And 56% is already gone. I am very sure that another 20-25% in next 2 months we should be able to give. By that, 80-85% of the money would have gone to them. Then remaining 20% plus accrual for this 1 year, that may be a little slow process, but we are trying our level best that we should be able to give the money back to the investor at the earliest.
So coming back to equities, what are the a few sectors that your fund managers are currently focusing on for the next 3 to 5 years?
See, this is always first thing first. More than sectors, we are always known as a fund house which has a bottom-up approach. Our research team is very very strong. We are agnostic to the sectors at any point of time. But as of now, if you ask me, as on date, what we are doing, we are very very bullish on the chemical sector. We are very bullish on as a fund house. We are on the manufacturing sector as well as on the pharma sector. Pharma sector is something which we feel that with the kind of attention which will be given to the healthcare even after the pandemic is over, and with the kind of specialization which country has already created, our company should do very very well. And in that also our research is quite strong, and we are sure that we'll be able to pick the stocks at a very very fair value. Already we are very strong. If you look at the performance of our pharma fund or our other fund like the value fund, which is contra fund, look at the trends. We have been able to do a pretty good job for the investors, and most of our funds are in the top quartiles only. So that's something which gives us confidence.
All right, we leave it there. Thank you very much, Mr. Singh, for coming by again in these difficult times, taking time out and sharing your thoughts and views with our viewers. Thank you. All right, that was Mr. DP Singh. We'll be back next week with another episode of Mutual Fund Masters. Keep watching Money 9.